Okay? They want to go try and refinance this. Well, their problem is they have a current mortgage of $160,000. So their mortgage exceeds the value of their house. Okay? This triggered a phenomenon where this person would say, rather than refinancing, I'm going to give my house back to the bank. I'm going to let the bank foreclose on my property. Okay? And by virtue of this foreclosure process, this is the phenomenon that crippled the financial system. So it's a couple things that people will cite. The housing bubble, inflated value here. The lax lending problem. So money was very available, it was very cheap. They were not using very disciplined lending standards. And then, when the values corrected and the housing prices came down, this group of people opted, a certain percentage of people opted to foreclose, to give the property back to the bank. And when that happens, now the bank on the front surface is the bank would own a house worth $140,000. They've got a loan against $160,000 on it. Banks don't want to be in the business of owning homes. So this single sort of series of events happened in a very dramatic way. Just to give you an example, in 2006, there were 726,000 foreclosures. In 2007, there were 1.3 million. And in 2008, up here, there were 2.3 million foreclosures. So you see what happened is you have almost a doubling here and nearly a doubling again of the amount of foreclosures. The person who's in this situation giving their property back to the bank. Okay? Doesn't sound like a complex problem. Doesn't sound like it's all that unique or whatever. Well, let me show you then how this scenario played out in the financial system. So let's say they originated the loan. When they went to take out the loan, they went to pick up St. Cloud State Bank. Okay? And St. Cloud State Bank was the person who originated the original loan. I'm going to say St. Cloud State originated this loan. Okay? They took that loan, so they originated that loan, and they sold it to a group. I'm going to call this group, I'm going to call it Goldman Sachs. They sold to an investment bank. Okay. So they took this loan, sold it to the investment bank. Now the investment bank would go around the country and they would buy 45,000 mortgages. Okay. Just like this one. Originated, an adjustable rate product, originated, and Goldman Sachs would take all these mortgages and put them together in a pool of assets, okay? And then they would package this, okay? And they would sell it to an investor, okay? So the investor would be buying a bond, if you will. So they take 25,000 mortgages, package them together, and sell it to this investor. And the investor was of a view that, look, I think I ought to be earning 7% on this pool of mortgages, okay? So he thinks he's going to earn 7%. And embedded in, when they created this product or this model, they made an assumption. They made an assumption that 8% of the mortgages would be forfeited or default. That 1 out of 12 of these mortgages, you'd have 1 out of 12 of these go into a default scenario. What happened in the summer of 2000, late 2007, is you began to see this problem exacerbated, and the actual default rate on these mortgages was more like 20%. Okay? So that instead of thinking that 8% were going to fail, it was 2.5 times that amount. And so when more and more of these mortgages were going and failing in default, the value of this bond, and so you typically issue a bond at par, so the bond would trade at $100 when it's issued, and as long as it's earning 7%, it's going to be able to be trading in that range. And this bond is secured by all these mortgages, okay? And embedded in that was an assumption that there'd be an 8% default rate. So that's kind of baked into it. When the default rate is 2.5 times higher than that, the value of the bond starts decreasing, okay? So let's say the value of the bond goes to 80, okay? It loses 20% of its value. The investors who owned these bonds, the investors who bought these bonds, were often banks, investment banks, hedge funds, a whole group of investors who are looking for this return. And what they fundamentally got wrong, and this is what one of the lessons learned, is they mispriced the risk of the bond. They never anticipated they were going to get a 20% default. They anticipated 8%. So they massively mispriced this, which meant they're going to start losing value in this bond. And unfortunately, nobody knew where the ultimate floor was going to be on the housing market. So they didn't know, what the underlying value to these assets, the assets that were backing this bond, was 25,000 mortgages. So the guys who were the investors were often banks, investment banks, hedge funds, etc. They own literally billions of dollars of these bonds. And so the first one that fell was a firm called Bear Stearns. In February of 2008, Bear Stearns had a huge portfolio of these bonds. And these bonds went into free fall, and Bear Stearns went bankrupt, went out of business, because they have to keep a certain amount of capital supporting these assets. And when these go into free fall, what happened was Bear Stearns, on their balance sheet, it's a whole different story, a different complexity, but Bear Stearns would have like $5 of equity and $95 in debt. And when they lost 20% of the value, it wiped out all of Bear Stearns' equity. Happened very quickly, happened over about 2 weeks. This program really began exacerbating. One of the things that nobody really understood, I've been around Wall Street a long time, I didn't really understand. But when Goldman Sachs, who was this intermediary who packaged this pool, they put together a product called CDO, Collateralized Debt Obligation. And what it was is they go to a big insurance company, and they go to AIG, who's a big insurance company, and they say, AIG, we want to buy insurance against the default. We want you to insure us against that. There'll only be an 8% default rate on this, okay? And so AIG said, sure, pay me a premium, and I'll insure that. Well, what happened is all of the bonds went in free fall all the time, and AIG didn't have the resources to meet the insurance requirement. They sold people an insurance policy and they couldn't honor